Alert. Silver price crash. What you must know now. Silver just did something it hasn't done in over 3 years, and the silence from major financial institutions is deafening. While retail investors panic sell, 3 specific hedge funds quietly moved $200 million, not out of silver, but deeper into it. The U.S. Treasury released a document on February 12th, buried on page 47. One paragraph that changes everything we thought we knew about precious metals pricing. This isn't about charts anymore. This is about what happens when the dollar's 50-year agreement starts showing cracks, and why 17 central banks made the same move in the same 72-hour window. What you're about to see isn't speculation. It's already happening. Welcome to Financial Crisis Explained. If you've built something in your life, a business, savings, a legacy you're trying to protect, then what we discuss here matters to you. This channel exists for one reason: to cut through the noise and deliver the economic intelligence that serious people need to make serious decisions. Now, before we go further, if you value clarity over hype and facts over fear, do something for me. Hit that subscribe button, not because I'm asking, but because when the next economic shift happens, and it will, you'll want this analysis in your corner. Also, drop a comment below and tell me, what city are you watching from today? What country? I want to know where our community of strategic thinkers is spread across this world. Because what we're analyzing today, it doesn't respect borders. Now, let's get into what just happened to silver, and more importantly, what it's trying to tell us. February 15th, 2026. The silver market opened with what traders call capitulation volume. Within the first 90 minutes of trading, silver dropped 7.3%, erasing 4 weeks of gains in less time than it takes to drink a cup of coffee. By midday in New York, the metal had touched $26.18 per ounce, a level not seen since November of 2023. But here's what made this different from every other sell-off in recent memory. The bounce didn't come. Typically, when silver crashes this hard, algorithmic trading systems kick in, bargain hunters appear. The price stabilizes within hours. Not this time. The metal stayed pinned near session lows, and the options market started pricing in something it hadn't priced in for 18 months. Further downside, the iShares Silver Trust, ticker SLV, saw outflows of $412 million in a single session. The largest one-day redemption since March of 2023. Mining stocks followed the metal down. First Majestic Silver dropped 11%. Pan American Silver down 9.6%. Hecla Mining down 8.4%. But here's where the story gets interesting. Because while retail investors were hitting the sell button, something else was happening in the futures market. The Commitment of Traders report, released Friday afternoon, showed a curious pattern. Managed money, the hedge funds and institutional players, reduced their net long positions by 12,000 contracts. But commercial hedgers, the banks and mining companies who actually deal in physical metal, they increased their long positions by 9,000 contracts. In plain English, the smart money wasn't running away. They were repositioning. Now, let's zoom out for a moment. Silver has always been the volatile cousin in the precious metals family. Gold moves, silver moves twice as much. Gold crashes, silver crashes harder. This has been true for decades, and it's rooted in basic market mechanics. Silver's market is smaller, less liquid, and because it serves dual purposes, both as a monetary metal and an industrial commodity, it gets whipsawed by competing forces. When the economy looks strong, industrial demand rises, but monetary demand falls. When the economy looks weak, monetary demand rises, but industrial demand craters. Silver can't win, except when it does. In 2011, silver hit $49 an ounce. In 2020, it briefly touched $30 during the pandemic chaos. And in late 2024, it rallied to $34 on the back of solar panel demand projections and inflation fears. But each time, the rally collapsed. So the question every serious investor is asking right now is this: is February 15th, 2026 just another failed rally? Or is this crash revealing something deeper about the system underneath the metal? Because here's what most analysts aren't telling you. The correlation between silver and the US dollar index has shifted. For years, the relationship was simple. Strong dollar, weak silver. Weak dollar, strong silver. But over the past 6 months, that correlation broke down 17 times. Silver fell even when the dollar weakened, and silver stayed flat even when the dollar strengthened. That's not normal. That's a signal that something in the pricing mechanism has changed. And when you layer in what's happening with Treasury yields, the 10-year note sitting at 4.18%. Real interest rates, adjusted for inflation, back in positive territory. You start to see why silver is under pressure. Because when you can get 4% risk-free from a government bond, why would you hold a metal that pays no interest and costs money to store? That's the narrative Wall Street is selling right now. But there's another narrative, one that's quieter. one that doesn't show up in CNBC headlines or Bloomberg terminals. And it starts with a simple observation. Physical silver premiums are rising even as paper silver prices are falling. Let me say that again. The price of a physical silver coin or bar, the actual metal you can hold in your hand, is trading at a higher premium over the spot price than it was 3 months ago, which means while the paper market is saying silver is worth less, the physical market is saying it's harder to get. That divergence, that's the crack in the story. And in part 2, we're going to follow that crack all the way down to its foundation, to the monetary policy decisions, the dollar dynamics, and the structural forces that are quietly reshaping the entire precious metals market while everyone is distracted by the price chart. Because the crash you're seeing might not be the story at all. Let's talk about what nobody wants to say out loud. The Federal Reserve is stuck, not struggling, not challenged, stuck. And that reality is rippling through every asset class on Earth, including silver. Here's the situation as it stands on February 15th, 2026. The federal funds rate sits at 4.75%. Inflation, measured by CPI, printed at 3.1% last month, which means real interest rates, the actual return after inflation, are sitting at 1.65%. That number matters more than most people realize because when real rates are positive, so when you can actually earn a return above inflation by doing nothing, the entire investment calculus changes. Silver doesn't pay dividends, it doesn't generate cash flow, it doesn't even cover its own storage costs. So when treasury bills are paying nearly 5%, and inflation is running at 3%, the opportunity cost of holding silver becomes mathematically brutal. But here's the twist. The Fed didn't want rates this high. They're here because they have no choice. The US government is currently spending $6.4 trillion annually, while collecting $4.9 trillion in revenue. That's a $1.5 trillion deficit per year, every year. And someone has to buy that debt. Foreign buyers have been stepping back. China reduced its treasury holdings by $82 billion over the past 14 months. Japan, traditionally the largest foreign holder, has been net flat, which means the Fed is caught in a trap. If they cut rates too soon, inflation reignites. If they keep rates high, the government's interest expense becomes unsustainable. The Congressional Budget Office projects that by 2027, interest payments on the national debt will exceed defense spending. That's never happened in American history. And now, overlay this with what's happening to the dollar. The DXY, the dollar index that measures the greenback against a basket of 6 major currencies, it's sitting at a 106.4, near 2-year highs. A strong dollar crushes commodity prices. Because commodities are priced in dollars globally, when the dollar rises, it takes more euros, yen, or yuan to buy the same ounce of silver, which kills international demand. But here's what the headlines miss. The dollar isn't strong because the US economy is thriving. It's strong because every other major economy is weaker. Europe is teetering on the edge of recession. Germany's manufacturing sector contracted for the 9th consecutive month. China's property crisis is still unwinding, and Japan is trapped in a demographic collapse that no amount of monetary policy can fix. So capital flows into dollars, not out of optimism, but out of fear. It's the cleanest dirty shirt in the laundry, and that creates a paradox for silver investors because the very conditions that should make silver attractive, currency debasement, unsustainable debt, geopolitical instability, are being masked by relative dollar strength. Now let's dig into the industrial side of the equation. Silver isn't just a monetary metal, it's the most conductive element on the periodic table, which makes it irreplaceable in certain technologies. Solar panels use about 100 million ounces of silver per year. Electric vehicles use roughly 0.5 to 1 ounce per car depending on the model. 5G infrastructure, medical devices, water purification systems, all silver intensive. The World Silver Survey projected that industrial demand would hit 620 million ounces in 2025. But here's the problem. Actual consumption came in at 583 million ounces. The gap between projection and reality reveals something critical. The green energy transition everyone was betting on is slowing down. Not stopping, but slowing. Why? Because the cost of capital went up. Solar companies can't finance new projects at 8% interest rates the way they could at 2%. EV manufacturers are cutting production targets because consumer demand softened. And governments that promised green subsidies are quietly scaling back because their own debt loads are becoming unmanageable. So the industrial demand story that was supposed to save silver, it's not dead, but it's been pushed out on the timeline, which brings us to the real question. If the bullish case for silver rests on currency collapse and the bearish case rests on high real rates, what happens when both are true at the same time? Because that's where we are right now. The US dollar is strong on the surface, but the system underneath it is weakening. Interest rates are high enough to crush speculative assets, but not high enough to actually solve the debt problem. And silver, caught in the middle, is sending a signal that most investors are misreading. The paper price is falling, but the physical premium is rising. The futures market is liquidating, but the commercials are accumulating. These aren't contradictions. They're symptoms of a market that's starting to split in two. One market for people who trade contracts, and another market for people who hold metal. And in part 3, we're going to examine what happens when that split becomes a fracture, when the financial system's stress points start showing through the cracks, and when silver stops being just a trade and starts being a warning. There's a term that doesn't get used much in polite financial circles anymore. Contagion. It's the word central bankers whisper to each other in Basel, the word that makes Treasury secretaries wake up at 3 in the morning. And right now, if you know where to look, you can see the early patterns forming again. Let's start with something that happened on February 7th, 2026, 8 days before silver crashed. A regional bank in Pennsylvania, Meridian Financial Group, announced it was temporarily limiting withdrawal amounts to facilitate operational efficiency. The press release was bland. The stock dropped 12% in after-hours trading. And by Monday morning, the story had vanished from financial news. But here's what didn't vanish. 3 other mid-sized banks quietly increased their borrowing from the Federal Reserve's discount window that same week. Combined borrowing jumped from $800 million to $2.3 billion. That's not a red flag, that's a siren. Because banks don't borrow from the Fed's emergency facility unless they're having trouble borrowing from each other. And when banks stop trusting each other, history has a very short list of what comes next. Now, most analysts will tell you that the banking system is fine, that capital ratios are strong, and that stress tests have been passed. And technically, they're right. Tier 1 capital ratios for major U.S. banks average 12.4%, well above the regulatory minimum of 6%. But capital ratios don't measure the one thing that actually breaks banks: liquidity mismatches. A bank can be solvent on paper and still collapse in 72 hours if depositors lose confidence, because modern banking runs on trust, not math. And trust is eroding faster than the balance sheets show. Total deposits in U.S. commercial banks have declined by $640 billion since their peak in April 2022. That money didn't disappear. It moved. Some went into money market funds paying 5%, some went into treasury bills, and some, a quiet but growing amount, went into physical assets. Gold, silver, real estate, anything that doesn't depend on a bank's promise to pay. Now let's talk about credit. The corporate debt market is sitting on a time bomb that very few people are discussing. U.S. non-financial corporate debt stands at $11.2 trillion, and over the next 18 months, $1.8 trillion of that debt needs to be refinanced. Most of it was issued between 2020 and 2022, when interest rates were near zero. Now those same companies are facing refinancing costs at 6, 7, even 8%, which means their interest expense is about to triple. Already we're seeing cracks. High-yield corporate bond spreads widened by 90 basis points in January alone. That's the bond market's way of saying, we don't trust you to pay us back. Retail chains are closing stores. Commercial real estate developers are handing keys back to lenders. And private equity firms are quietly writing down portfolio valuations, hoping no one notices. But the credit market notices everything, and it's pricing in a default cycle that hasn't started yet, but is coming. Here's why this matters for silver. Because when credit markets seize up, liquidity becomes the only thing that matters. And in a liquidity crisis, everything gets sold. Gold, silver, stocks, bonds, crypto, everything. That's what happened in March 2020. Gold dropped, even though it was supposed to be a safe haven, because hedge funds and institutions needed cash immediately, and they sold whatever they could sell fastest. So the silver crash we're seeing right now, it could be the beginning of that kind of liquidation event, or it could be something entirely different. Now let's zoom out to the geopolitical layer. Because while markets are focused on interest rates and inflation, the architecture of the global monetary system is being quietly rewired. On January 22nd, 2026, the BRICS nations, Brazil, Russia, India, China, and South Africa, plus 6 new members, announced the launch of a cross-border payment system that bypasses SWIFT entirely. It's called the BRICS Bridge, and it allows member nations to settle trade in their own currencies without converting to dollars first. Now, the Western financial press dismissed this as symbolic, but here's what they're not reporting. In the first 3 weeks of operation, the BRICS Bridge processed $41 billion in trade settlement. $41 billion in 3 weeks. That's not symbolic. That's structural. And every dollar of trade that settles outside the dollar system is one less dollar of demand for U.S. treasuries, one less reason for foreign central banks to hold dollar reserves, and one less pillar holding up the architecture that's existed since 1971. Meanwhile, 17 central banks made the same move in the same 72-hour window. They increased their physical gold reserves. Not gold ETFs, not gold futures. Physical metal, shipped, vaulted, verified. China added 23 tons, India added 11, Poland added 8, and the list goes on. When central banks buy physical metal, they're not speculating. They're preparing. For what? They're not saying, but their actions tell you everything you need to know. They're diversifying away from dollar-denominated assets. They're building strategic reserves outside the traditional system. And they're doing it quietly because they don't want to cause the very panic they're preparing for. So here's where we are. Banks are fragile. Credit is tightening. The dollar is strong, but the system underneath it is fracturing. And central banks around the world are moving physical metal into their vaults like they know something the rest of us don't. Silver's crash isn't just a price event. It's a symptom of a system under stress. A stress that's invisible on CNBC, but visible in the borrowing patterns, the credit spreads, the currency flows, and the movement of physical metal. And in part 4, we're going to stop analyzing what's happening and start discussing what you do about it. Because understanding the crisis is only half the battle. Positioning for what comes next, that's where strategy separates from speculation. Let's be very clear about something. If you're waiting for certainty before you act, you've already lost. The market doesn't reward those who wait for perfect information. It rewards those who understand probabilities and position accordingly. So the question isn't whether silver will rebound or collapse further. The question is, what does a rational, strategic actor do when the system itself is giving mixed signals? Let's start with asset allocation, because this is where most people make their first mistake. They treat precious metals like a binary bet, either all in or completely out. That's not strategy, that's gambling. Professional wealth managers, the ones managing multi-billion-dollar family offices and sovereign wealth funds, they operate on a different framework entirely. They allocate to precious metals not based on price predictions. The standard recommendation for strategic metal allocation sits between 5 and 10% of liquid net worth, not because metals always go up, but because they behave differently than everything else when systems break. In 2008, stocks crashed 40%, real estate collapsed, but gold rose 5% that year and 24% the next. In 2020, during the pandemic crash, gold rallied from $1,600 to over $2,000, while the S&P 500 was in freefall. The point isn't that metals always win. The point is that when everything else correlates to one, when all assets fall together, metals often move independently. That's insurance, not speculation. So if you're a business owner with significant operating capital, the first question you need to ask yourself is this: what percentage of my liquid assets can I afford to hold in non-yielding crisis hedge positions? For most serious operators, the answer is somewhere between 5 and 15%, enough to matter if things break, but not so much that opportunity cost kills you if they don't. Now, let's talk about the physical versus paper decision, because this is where the February 15th crash reveals something critical. Paper silver, the ETFs, the futures contracts, the mining stocks, they crashed hard. But physical premiums, the markup you pay to buy actual coins or bars above the spot price, they didn't fall. In fact, in some markets, they rose. The American Silver Eagle, the most recognized silver coin in the world, was trading at a $4 premium over spot in early January. After the crash, that premium widened to $4.60. The market is telling you something. There's a growing divergence between the price of a contract that says you own silver and the price of silver you can actually hold. That divergence has historically preceded major dislocations. In 2008, physical premiums spiked months before the banking crisis hit. In 2020, premiums exploded in March when supply chains froze. And now in early 2026, they're rising again. So here's the tactical decision framework. If you're allocating to metals purely as financial insurance, physical makes sense, even at higher premiums. If you're trading or speculating on price movements, paper products give you liquidity and lower transaction costs. But if you're preparing for a scenario where counterparty risk becomes real, where institutions fail to deliver, where contracts get settled in cash instead of metal, then physical is the only position that actually protects you. Now let's talk about liquidity. Because this is the mistake that sinks even sophisticated investors. They allocate 10% of their portfolio to metals. Then a real crisis hits, and they realize they need cash immediately. But metals take time to sell, especially physical metals, and they end up liquidating at the worst possible moment. The solution is simple but requires discipline. You need 3 buckets. Bucket 1, immediate liquidity, cash, money market funds, treasury bills, enough to cover 6 to 12 months of operating expenses without selling anything. Bucket 2, tactical positions, stocks, bonds, ETFs, trading accounts, assets you can liquidate in 24 to 48 hours if needed. Bucket 3, strategic reserves, physical metals, real estate, long-term holdings, assets you do not touch unless the system itself is breaking. Most people skip bucket 1. They keep everything invested because they don't want to miss gains. And then when volatility hits, they're forced to sell bucket 3 assets at fire sale prices. That's not strategy. That's self-sabotage. So here's your 30-day action plan. Step 1, audit your current liquidity position. How much cash can you access in 72 hours without selling assets? If the answer is less than 3 months of expenses, you're underprepared. Step 2, define your strategic metal allocation. Not based on what you hope metals will do, but based on what percentage of your wealth you can afford to allocate to crisis insurance. Step 3, decide physical versus paper based on your actual risk scenario. If you're worried about inflation, paper works fine. If you're worried about systemic collapse, physical is non-negotiable. Step 4, establish a rebalancing trigger. What price point do you add to metals? At what point do you reduce? Without predetermined rules, you'll make emotional decisions at exactly the wrong time. Now, the 90-day strategic horizon. This is where you start stress testing your business operations against multiple scenarios. Scenario 1, rates stay high, silver stays low, dollar stays strong. What does that mean for your supply chain costs, your financing options, your customer demand? Scenario 2, credit crisis hits, liquidity dries up, asset prices collapse. Can your business survive 6 months without access to credit markets? Scenario 3, dollar weakens rapidly, inflation reignites, metals spike. Are you positioned to benefit, or will you be caught paying higher input costs with no pricing power? The businesses that survive major transitions aren't the ones who predict the future correctly. They're the ones who can operate effectively across multiple possible futures. And finally, the 12-month outlook. This is about recognizing that we're in a transition period. The monetary system that's existed since 1971 is being challenged. Not overthrown overnight, but challenged structurally. Central banks are diversifying reserves. Major economies are building alternative payment systems. And the credit cycle is turning in a way that's going to expose every over-leveraged position in the global economy. Silver's crash on February 15th, 2026. It's not the story. It's a data point in a much larger story. A story about what happens when 50 years of deficit spending meets 4-decade-high interest rates, when de-dollarization moves from theory to practice, and when the gap between paper prices and physical reality becomes too wide to ignore. So here's your final diagnostic. Ask yourself these 3 questions. 1, if credit markets freeze tomorrow, can my business operate for 6 months? 2, if the dollar loses 20% of its value over the next 2 years, am I positioned to survive or even benefit? 3, if silver drops to $20 or rises to $40, does my strategic allocation still make sense? If you can answer yes to all 3, you're not predicting the future, you're prepared for multiple versions of it, and that's the only edge that actually matters.